Hi, everyone. It's Larry Kotlikoff back with Economics Matters. I'm delighted to have, for the third time, Fred Lane, who's the head of CEO of Lane Generational, which is uh, a fund that you can invest in through Fidelity. Uh, uh, Fred is extremely well known to the investment world. I'm going to let him actually describe his background because he'll do a better job and he'll do it in shorter time. But we're going to try and discuss today the markets and how he sees. Fred has an immense amount of experience in investing, but also in invest, in actual startup companies and investing. I think you were an early investor in Staples, as I understand.
Yes,
Uh,
correct.
so,
Yep.
Fred, take it away. Tell us, I like to ask people where they were born, and I'm not sure you gave us the
Right.
story of whether when you were a 10-pounder.
I can get, oh, you've heard that. You remember that? Yeah, I was a big kid, 10 and a half pounds. So
You
I was
went to
born in
Harvard
Boston,
and University.
Massachusetts. I was born on my father's side. My father was a first generation immigrant. His parents were from Cork, Ireland, and they spoke with a very strong brogue. And my father went to Harvard College and had a chip on his shoulder because he wasn't one of those rich kids. And so I was brought up with, in my view, immigrant values, which is fantastic for me. So glad I had that. I'm the youngest of three kids. I was brought up in the Boston area. My dad was a physician. I went to the Roxbury Latin School, and then I went to Harvard College, and then I went to Harvard Business School, all straight through. And then leaving Harvard Business School, I went into public accounting for 3 years. I was very young when I graduated from Harvard Business School. I was 23, and I had no real work experience. So going to public accounting was a great experience for me. And I left there knowing that it wasn't what I really wanted to do long term. So I went to Wall Street and I joined a firm called Donaldson, Lufkin and Jenrette. I was there 25 years. I ran the M&A group at one point. And DLJ was a very unusual firm. We were very small when I got there. And one of our primary businesses, we were in the money management business actually through Alliance Capital Management. That was one of the engines that allowed us to survive. And we also had a very successful venture capital business, which was very small by today's standards, but the largest dedicated fund in
Mhm.
those days, which was 150 million of paid in capital. That was I should say, committed capital. That was the last fund they raised. Well, the fund they had when I was there, and then we got much bigger in the private equity and merchant banking business, but it was very difficult times. Nobody went to Wall Street, with the guarantees and the big money of today. People forget that in the 70s, I mean, when I got to DLJ in 1976, the average trading volume in the New York Stock Exchange was 10 million shares a day. And the Dow was selling at 400, going to 300. So it was a very different world indeed. And we've had a tremendous amount of capital formation. At some point, be happy to go through the laundry list of factors that have allowed us all to live lifestyles and have wealth beyond any imagining. I mean, it's really amazing what's gone on as a result of population growth, the baby boomers coming into the market. In my view, some tax cuts were very helpful. Some forced retirement programs, IRAs were essentially forced retirement funding. If you had any sense, you did that. And then 401k liberalization. So you take all of those factors together, and I think they've driven markets, not only the stock market, but also the private equity market, the venture capital market, the real estate market, and so on. So capital is now available to an extent that was unimaginable when I got into the business in the 1970s. Then after DLJ was acquired by Credit Suisse First Boston in 2000, I started a firm called Lane Berry. We were a small boutique. We had about 40 people at the top, and we were sold to Raymond James in late 2009. And I stayed on as vice chairman at Raymond James and then started managing money at Raymond James, since all my training, quite honestly, was basically preparation for managing money. I'd never done a trade, I should add, when I started managing money, so I had some basic learning to do. But the fundamentals of how to invest, how to be diversified, how to analyze companies, how to analyze markets, the macroeconomic factors, all of that I think was in place. So it really made for a very enjoyable transition. So I basically started building this new career about 10 years ago. So Lane Generational is a wealth management firm, but we're really an investment management firm. We specialize in one um, basically proprietary portfolio. We have about 25 holdings in that portfolio, sometimes less. We typically, unless we're very bullish, are basically hedged with some cash. We usually have 10 or 12% in cash at any point in time, waiting for opportunities. And we invest where we see the best absolute return potential. So, we started off being very technology oriented, but over the last 2 or 3 years, and Larry knows this quite well, we've become
I'm an
much more.
investor.
Yeah, he's an investor with us, and we own technology stocks, but we also own some precious metals, and those have been very, very strong performers. In fact, precious metals, gold, as an example, has outperformed slightly the S&P year to date, and silver has outperformed the S&P year to date by about 700 basis points. So, those, and why would we own those? We would own those because our basic view is that inflation is going to continue, it's going to be persistent, and a lot of the policies under the Biden-Harris administration and a lot of the policies under the Trump Vance administration are inflationary. Energy policy, in my view, under the prior administration was inflationary, but we're going to have inflationary factors coming from other government programs as well. I mean, we have become, over the last 20 years, a very strongly, I should say, a much more heavily influenced economy driven by political government policy. Government policy is a lot more important and a lot more active than it was 20 or 30 years ago. In my view, it's excessively so, but so be it. But our view is that inflation is going to continue, which is one of the reasons that we continue to believe that holding precious metals and other commodities at times makes sense. In 2021, I think, or 22, I remember this well because I was on the TV with Maria Bartiromo on Fox Business, I believe. And she said to me, do you have any unusual ideas, or what are you thinking? And I said, well, quite honestly, we're thinking that oil and gas is an area where we should be invested. And because it's never been an area that I've liked particularly, I'm not a commodities investor. But anytime an industry is so demonized and hated, this was in the height of the ESG mania, I guess I call it, I should probably be interested in it. And so we bought oil and gas. We were a little late to the party, quite honestly. And it's basically underperformed this year, which means, and we believe that it's probably pretty good going forward. But nothing I say here should be taken as don't interpret this as recommendations on my part. Happy to talk to anybody who wants to talk to me directly. They can pick up the phone and call me, or my number's on the Lane Generational website. But I think we have a little bit of a contrarian view versus most people. Our view on inflation was that it was transitory. This was not transitory, I should say. We're on record saying that in our blogs, on our website, going back to 2020 and 21. And the factors driving inflation have gotten even more dramatic since then. So it's been an interesting time to invest. We've been very, very, very pleased with our results. You can interpret that as we've done quite well, and particularly on a risk-adjusted basis, because
I was just looking at my report yesterday, so
yeah,
I can confirm.
Yeah, no, it's been quite remarkable, but we haven't invested. We could have done better. Oh, by the way, if we had followed the momentum of certain holdings that we had, but we basically, we are price sensitive, we are valuation sensitive, and when a stock is hugely up versus our basis, and versus, more importantly, where we think it should be trading long term, and it's really outrun, let's just say its 200-day moving average is X and it's trading at 2X or more, that's typically a warning sign. We have an existing holding that's trading at even higher multiple, and frankly, it's got all sorts of positive momentum on the one hand, but we also have a gigantic tax bill for our clients if we sell it now. So we're trying to figure out how to manage that risk. So it's been.
Of course, you can hold your Fred's fund through your IRA.
Correct.
So you wouldn't
Absolutely.
necessarily have a tax bill from any
Absolutely.
realization. But
Yeah.
I think what you're kind of alluding to is the value of having an advisor manage your money. I'm pretty down on the advisor community because of the way they do their financial planning, as you know.
Right.
But
Right.
I've seen so many people that get psychologically stuck with, for example, Bitcoin. I know young people that have holdings of Bitcoin now. It's going out the roof. They are saying to me, "Well, I told you so," and uh, and I said, "Well, now's you're absolutely right. I was wrong. You've done well. You hit the jackpot." I think it's. We'll talk about what do you think of that, where Bitcoin is and the market in general. But um, I said, now's exactly when you should sell. Oh no, I'm not going to sell. I'm going to hold on to it because apparently it's going to go to infinity. But if you have an advisor, advisors are used to selling things. They're not becoming kind of emotionally attached to their holdings
Right.
and worried that they're more worried about not making the next killing as opposed
Right.
to having the the money secure so they can make a down payment on their home
Right.
that they
Right.
haven't bought yet.
Right.
Um, and so this is where advisors can help psychologically deal with your
Absolutely.
psychological problems. But tell
Absolutely.
us about where you see the markets in general. I mean, the stock market's done enormously well. The is this obviously we're going to have, I think there's a general belief that the Tax Cut and Jobs Act will be retained,
Right.
which will keep. And then Trump has talked about lowering the corporate tax rate from, I think, what's now around 21% down to 15.
Right. Which I'm not in favor of, but that's neither here nor there.
So he wants to do that. He wants to eliminate taxation of Social Security benefits.
Mhm.
He wants to retain the TCJA. Um, he wants to eliminate tips, taxation of tips
Mhm.
at the restaurant that
Right. Right.
not inflation index bonds, but everybody, people getting
We,
tips.
we, we know we no longer we don't charge fees anymore. We're just going to charge tips.
Yeah. So I get paid from BU in tips, I hope.
Right. Exactly.
I'm gonna bring
Exactly.
a tips jar to my classes, I decided.
Right. Right.
You say tips. It'll be a BU class, say BU tips. Um, so, and I imagine there are a few other things that I've forgotten here that he wants to
Well,
he's gonna
of
blow
course
an enormous hole in the deficit,
we
which is
have this whole tariff issue, right? And so and we
the
already
tariff.
have tariffs. We have some tariffs already. Some were put in by Biden, some predate, excuse me, by Trump. I think some even predate Trump. Biden left some of them, most of them actually in place. I'm not, I mean, my view on tariffs is, see, I have a different view in general, which is I think we need to have a cooperative relationship with our trading partners and our allies. We can't treat them as enemies because they can compete more effectively against us in certain areas. I don't have to tell you, Larry Kotlikoff, Professor Kotlikoff, that an efficient economy does what it does well and gets paid for that, and others will do what they can do well efficiently, and they get paid for that, and that's kind of fundamental to economic growth and trading. So we've been exporting pollution and labor costs to Asia and elsewhere for the last 40 to 50 years, right? And now to suddenly say, oh no, we can manufacture as effectively as somebody else, and to treat those trading partners as enemies. Now, where they're political enemies and geopolitical enemies, China maybe, although I frankly think we're demonizing China excessively. I shouldn't say that, but I do feel that way. And not to say China's our friend. I mean, I think China is not our friend. I think they do spy on us, but we're not completely lily white either. Oh, by the way, and I think to get in real wars with Mexico and in particular and Canada over tariffs is a mistake. But we'll see. I think a lot of this. I think so much of what we hear from Trump is negotiating bluster. and being the bully in the park and getting people to cooperate with him, which I guess from our point of view is in our best interest. But to the extent that we feel the need to replicate manufacturing capacity that exists elsewhere and more efficiently, um, to a large extent will be inflationary. So I'm in favor of some reshoring, bringing back to the United States manufacturing capability, but I'm not in favor of, basically imposing tariffs across the board. I think it's
And just to say, yeah, on manufacturing, this country is not into manufacturing anymore. We
no,
were
we're not. We're not.
30% of employment was in manufacturing in 1950. It was when Trump took office, it was 8% or so, a little bit more, maybe 8.4. It's now down to about 7%.
Right, right,
And it fell during Trump and it continued to fall during Biden, and they
right.
pretty much fell at the same slow rate. But we're just not, and to have your entire kind of industrial policy predicated on uh, going back to maybe making shoes and watches. Waltham, Mass had the watchtower, the watch building. We were the largest watch maker of wrist watches in the world in like 1890, I believe.
Yep, yep.
And but that factory now is closed, and that building is full of service industry companies. So it's just crazy to think we can make.
There's no U.S. shoe company that manufactures in the United States. I mean, New Balance does some. I mean, they do some assembly and
Yeah,
so
98% of our clothing comes from abroad.
right,
S- I bought this leaf blower uh, this fall.
right,
It's amazing. I never had we had a little small lawn. I never had a leaf blower. I got really kind of overly excited by it because it's so cool to use this. And I was like competing with Bridget, my wife, to who would get to use the leaf blower.
right, right.
So, and this thing is like, 75 bucks, says made in China, bought it from Amazon, gets there like in a
Mhm,
day.
mhm.
And the thing's fantastic, but for an American worker to make that, for American workers to make it, it would probably take 3 days at least, even with the help of robots. Whereas in China, and it would cost probably 10 times more. It's just,
Well, yeah, I don't know if it's quite that extreme, but yes, I totally agree with you. By the way, if you've ever seen here's what's really frightening, and I think it's worse for Europe than it is for the United States. Um, a major part of European industry has been the manufacture of cars, right? Volvo, Saab, um, General Motors is in Europe, Porsche, Mercedes, et cetera. And we all know there's been consolidation in that group. But the fact of the matter is that China can produce a car almost entirely without any human input. Completely, these are factories that are completely managed. They're managed remote. Obviously, there's somebody at the control center, but the assembly, the forming of the parts, the forming of the body, et cetera, is entirely done by robots. So, for us to be able to compete in the automotive industry is very tough. I mean, Europe has a much bigger problem than we do. I mean, thank God we have the technology and the appetite for risk and the appetite for putting capital into growth companies that we do, because it's really the salvation of the United States. If we continue to be the innovator and the disruptor, I think we will continue to do well. We export a lot of good stuff. We export our culture, our entertainment, our brand names. So our brand names may not be produced here, but they certainly are valued. I mean, Nike is valued in China, as are a lot of European brands, Hermes, LVMH, all those luxury brands. All those European luxury brands are very much valued in China and the rest of Asia. So, um, I think time will tell how we evolve, but I agree with you. I think that for us to believe that we're going to somehow magically become an economy that's 25% based upon domestic manufacturing is fanciful. It's not
yeah.
realistic.
So Fred, let me ask you some, investing questions here for the investors. who are listening in or watching.
Right.
Do you think the stock market's overvalued? Would you short the stock? Would you get out of the stock market? Would you, you think it's
Uh,
we're in for a
well, let
adjustment?
me, yeah, let me first talk about fixed income, if I might, because I know fixed income has a place. And by the way, fixed income does have a place, but,
By the way, economists, just for the record here, economists never think the markets are overvalued. They think they're efficient. And uh, for the record, I'm asking you a question that is not a legitimate economic question because we think all the information is being processed appropriately and the market's at a value that is incorporating everything that's known and where it's going to move the next. There's a trend, obviously, uh, to the market because the capital that's in the market, the capital that's being valued by the market is producing output. And if a lot of it's being retained and therefore the market values go up. And there's been a 7.5% real return on the market since 25, the stock market. So it's a fantastic casino, but there's a 20% deviation in the return. But
sure.
no economist could really, or let's say, get by saying, I think the market's overvalued. But I'm wondering whether Fred Lane thinks the market's overvalued. Let's talk about retirement for a minute. It's something Americans think about regularly. Ask yourself, how financially secure do you really feel? Do you have enough money to retire? How much is really enough? And if you don't have enough money, how can you possibly find that extra money before you do retire? These are all tough questions. My retirement software, Maxify Planner, is the powerful online planning tool that takes the guesswork out of retirement. It weighs your assets against your fixed expenses to calculate how much you can safely spend every year for the rest of your life based on when you decide to retire. And it shows you safe ways to find more money. Maxify makes a complicated problem like retirement planning simple. It's accurate, easy to use, and produces what you really seek, peace of mind. So make the smart choice and visit Maxify.com today. Don't miss this opportunity. That's Maxify with an I, M-A-X-I-F-I, Maxify.com. Now let's get back to the podcast.
Well, I think it's very important to distinguish what do we mean by the market? Okay, so if we look at, there's some real distortions in looking at the market as the S&P 500, which by the way is the standard benchmark people use, because the S&P 500 even today has been dominated by a few very large market cap stocks. The S&P 500 is weighted by market capitalization. So an Apple, as an example, or an Nvidia, as an example, are stocks that have such high valuations. They tend to have a disproportionate impact on the S&P. And by the way, therefore, if you buy the SPY, the index of the S&P 500, when you put $1 to work, 10 or 15 cents go into the top 3 or 4 companies. Or maybe now if you had the equal weighted S&P, where literally each holding is 1/500th of the total, or approximately that. Okay, you had very different returns. The equal weighted return year to date is 17.3%. The S&P return is 27.4%. Quite a difference, eh? And interesting enough, the NASDAQ, the QQQ year to date is exactly the same, pretty much right as the same as the S&P. So what we're seeing here, we're seeing technology continue to dominate, but it's slowing. And we're also seeing the equal weight start to catch up. The equal weight, by the way, did nothing for 2 or 3 years, virtually nothing. And the reason I wanted to just mention the issue about bonds is because I think it's important to recognize that if you own the 10-year bond over the last year to date, you're down 5.3%. So, and in 2022, when bonds were supposed to be protective, they went down 20%. So the market went down, the bonds went down. Now, of course, that was because we got away from basically the low interest rate, zero interest rate environment, courtesy of the Fed. The Fed started increasing rates.
Inflation wiping out the real value.
But I think the market is overvalued on one level because it trades at 28 times earnings. And the dividend yield's 1.5%. It's more typically 2%. I would say that the market is overvalued, but again, the market is the S&P 500, and so you have to look through that. We think that we continue to see really interesting values out there. You have to dig for them, and a lot of them aren't the largest market cap values, and to some extent they've been left behind. And the reason they've been left behind is because when money flows into these indexes, the S&P 500, everybody says buy index funds. You know, Jim Cramer's on talking about buy index funds. He's right. Okay, they're fine. There's only one problem, and that is when the highest market cap stocks in the index roll over, which inevitably they probably will. One would think they might. Okay, that then the money that flows into that people who money has to the weighting has to change. They now those index funds have to sell the Nvidias, they have to sell the Apples. That hasn't much happened because the inflows have been very strong. But our view is that a more actively managed and a more I would say portfolio selection based on individual, working from the bottom up to find value. I mean, that's our goal, and we think that that carries with it over time less risk. But we'll see. It's but I will say this: people who say they don't want to be invested, remember this. Over the last 5 years, the total return of the S&P, now admittedly, this is the S&P, has been 108%. So that's over 15% compounded. My guess is the equal weighted would be more like 7 or 8%. But again, versus bonds, not that bad. I think the equal weighted will do better going forward. Who knows? But I think individual stock picking is ultimately going to be, it can be very, very helpful to a portfolio, as you know from your own experience with us.
So as we speak, you could buy 30-year TIPS, inflation index bonds, for 2.14%,
Mhm.
2.14. Would you tell somebody who's, let's say, in their mid-60s, who's retiring, that maybe now is the time to get out of the, I mean, I do a lot of personal planning through my company, through Maxify.com. There's
I know you do.
a,
Yeah.
a, a service people can
Mhm.
plan directly with me. I don't give any advice, investment advice, but I do talk about investments
Right.
like we are now, and show people how to use our software to look at their investments. Uh, and I have actually been doing a lot with financial planners who don't like the software that they're being forced to use by their company or that they're
Mhm.
used to, which is good for them to get new assets under management, but not, they realize its shortcomings when it comes to making their own,
And your software is very reasonably priced. I mean,
like
it's kind of
$149.
noise. I mean, it's almost free. I mean, quite honestly. So people
But
should use it, no question. Yeah.
yeah, so, but I talk to people and they say, well, I look at their situation, they say, well, uh, gee, I've done so well in the market, and I wouldn't want to uh, give that up because I think, and the return on tips is so low compared to what I've done on the market. And I said, well, now, you're a upper middle class person. You really want to lock in, you're about to retire, you want to lock in that living standard. And now's the time to do upside investing, basically set a floor to your living standard using a tips ladder, and just invest some portion in the market for a while, let it run for a while, and then don't spend out of it until you've converted it into tips. That's the upside investing strategy. Would that be something you would be pushing with older clients who are in that kind of boat?
No, to be honest with you.
Right.
There's no, listen, look, Larry, it really depends on the profile of the client, their willingness and ability to handle some volatility. But if someone is 65 years old and if it's a male and he's in average health, he's likely to live to his late 70s. So that's another 14 or 15 years. If we have inflation running at 3 or 4% and the returns from investing in fixed income are 2 or 3% or 4%, he's probably going to struggle to maintain his lifestyle. Now, admittedly, as people get older, they spend less and so on. But I think, my view is that what we like to do is to basically segregate, what portion do you need for distributions over the next couple of years? And we'll invest that in treasuries or something like that. And, and maybe some variants that produce a little bit higher income. But as you know, Larry, 90% of our assets or 85% of our assets are managed in our one strategy, which we call Helix. And that strategy is designed to produce strong absolute returns, and certainly strong inflation adjusted returns. Because I think one of the things people forget is, inflation is still running at a pretty reasonably high rate versus standard. And we now have the Fed saying, well, now 2.5% is fine. But the Fed needs inflation. And one of the ways to deal with the deficit is, Larry, better than I, is to have reasonably high levels of inflation. So I don't think the Fed is as anti.
Just so everybody knows, to erode the real value of the, if you pay back in watered down dollars, your federal Uncle Sam pays back what he borrowed from you in watered down dollars. He makes a real profit.
Right. And oh, by the way, having a strong stock market produces capital gains. Those capital gains therefore help, and obviously if those returns are inflated by the impact of inflation on pricing and profitability and so on, then that's good for the federal revenue collection as well. So, I think,
just to say to people there, if you go to kotlikoff.net, there's an article I did with some other economists and one of the vice presidents of the Federal Reserve Bank of Atlanta that helped fund the Federal Reserve helped fund this research, although they're not, responsible for any of the findings. But we looked at inflation's interaction with the fiscal policy, and it turns out if you went from a world of zero inflation to one of like 10% permanent, that's like a median tax hike, average tax hike, increasing everybody's taxes by about 8 percentage points. And it's actually much higher, around 15% at the median for the top 1%.
Right.
So inflation, the government makes a lot of money by making money.
Absolutely. And of course, my theory, which I don't think has necessarily been proven, but reducing tax rates somewhat, in my view, accelerates tax revenues as well, because people are less resistant to paying tax. They don't plan, let me avoid taxes because they're so high. If the capital gains rate were 10% or 12%, I can tell you we would be much, much, much less sensitive to incurring capital gains. If we have an investment, you have an investment in your portfolio. If you look at it carefully, you'll find one in particular that we invested in at quite a low valuation, call it 8, and it's now trading down today at 72, and that's in about a year. So it's been a 9-bagger. We're very happy with that. We don't get those every day. We did a lot of research in the company. We're a believer. It didn't actually perform very well initially, and it's performed great. But one of the reasons that we're dragging our feet a little bit about taking money off the table and how much money to take off the table, because it's pretty fully valued, no question about that. But one of the problems we have is the taxes. Our clients don't like paying taxes. Well, in an ideal world, we would only have gains. And if we were an actively managed portfolio, we'd always have some capital gains tax. That comes kind of with the territory. But we certainly try to avoid those taxes. We do tax harvesting. We'd rather have a long-term gain than a short-term gain, no question about it. But we don't want to necessarily let the tax tail wag the investment dog. So we want to be sensitive to that.
Let's talk about Bitcoin for a second here. What do you think of what's the $100 valuation for Bitcoin?
Yeah, around 100. It seems to be finding a base in the 95 to 102 area. Again, if you go to our website, I think you've done this, Larry, already. That we wrote an article in a blog. We call them insights on our website. We wrote a blog in November or December of 2020, making a case for Bitcoin. And the case was that it is essentially a store of value, and most attractive about it, it has a limited supply. There cannot be more than 21 million coins mined. It's decentralized, so you don't have any central party who can decide, oh, we're going to change the rules. No, it's decentralized. There are literally thousands of nodes out there who have a say in what's happening with Bitcoin. And so Bitcoin is basically, in our view, gold without the reproducibility, because gold is mined at a rate of 1 to 1.5% of outstanding value per year. So our view is that Bitcoin is, as long as people believe in it, as long as people believe in it, it's a great store of value. Now, the reason I say that, ask that question about do people believe in it? Well, do people believe in the U.S. dollar? What's it backed by? It's based the full faith and of the U.S. government, but the U.S. government sometimes does things that seem to be a little reckless, right? Spending being one. So our view is that Bitcoin is great for a portfolio that is it's for 1 or 2% of someone's net worth. That's it. Now, we had clients who got in at 25 to 30, 35,000. We have some who sold at 50, 55. We had one client who sold recently at 55, and I pleaded with her, please don't sell, please don't sell. But she did. And she now is not too happy with her decision. Do I think there's ever a time to sell some Bitcoin? Of course I do. But I also think that the tailwinds are very strong right now. I think there's greater and greater sensitivity to the federal deficit and what an intractable problem we have. There's more and more concern, therefore, about the dollar. And by the way, the strength of the dollar does not help us in terms of manufacturing here in the United States and exporting. As you know, we want a weak dollar, but we have a strong dollar. And so, all of this to us suggests that inflation is going to continue to erode the value of the dollar for us, and we're going to continue to have inflation. So our view is that Bitcoin is a very good way to protect yourself to some extent, as gold has been as well, and silver. But gold and silver have other factors that create a little bit of headwind, right? I mean, because gold is physical. It's expensive to own it physically. We actually have a program at Lane Generational where our clients can buy Bitcoin on our platform through Fidelity Digital Assets. It's the institutional platform. So when they buy Bitcoin, they actually buy the right. They don't have to. Most of our clients don't want to actually own it in an electronic wallet, but they do have dedicated Bitcoins in storage for them. So therefore, they have a security solution because Fidelity's security is extremely strong. And they don't have to worry about losing their passwords and their passcodes. So they can own it. And if they ever decide, because the world is coming to an end and, the apocalypse is now, which I don't think will be the case. But if that were the case, someone could certainly call us up, and we can have your Bitcoin transferred to an electronic wallet at that point in time. So, we have a lot of clients who feel they missed the boat on Bitcoin. Oh, I couldn't possibly buy it now, and we're not actively pushing it. Where a client has curiosity about it, and agrees with our thesis, we want to talk them through that, and we actually think it's probably a pretty good buy right now. When it was in the 30s and 40s, we thought it had the potential to get to 100. Nobody knew exactly when that was going to happen. And obviously, it's been a tremendous performer on an internal rate of return annual growth basis. But now it has less downside and regulatory risk, at least for the next 3 or 4 years, in our view, than it had previously. So even though it's at 100, our view is that $150,000 to $200,000 per Bitcoin is not necessarily out of the question.
By the way, you said that the maximum Bitcoin supply would be 21,000. Do you know what the current supply is?
21 million coins, and
21 million. Okay.
Yeah, and well, it's believed these numbers. It's very hard to track this, but it's believed that up to 1.5 million coins have been lost forever. Meaning, I bought it, I put an electronic wallet, I lost my electronic wallet, or I lost my password. I stored my password somewhere. I don't know where it is. Anybody who buys a Bitcoin that way should most assuredly, have a trusted, your spouse, whatever, and you should probably put a titanium, engraved card in some fireproof safe to preserve it. I mean, this could be urban myth, but supposedly there's a very wealthy guy in Boston who died, I don't know, a couple of years ago, and supposedly had 10 or 12 million of Bitcoin, which today would be more like 25 or 30 million of Bitcoin. And he had it stored in an electronic wallet, and no one knows the passcode. So the maximum, so right now, I'd say mined and outstanding, whether lost or not, is something like 18 and a half to 19 million coins. By 2040, 21 million coins will have been mined, and that will be it. To which you might ask reasonably, well, then how's the Bitcoin blockchain going to be maintained? And it's going to be maintained with service fees. So if I, Fred Lane, want to trade Bitcoin, I'm going to have to pay a service fee. As I would, if I own gold, I'm going to have to pay a storage fee, right? I have a very good friend from my Donaldson, Lufkin, and Jeanneret days who has most of his net worth in gold, physical gold. And he's got it in various locations, warehouses around the world. And he's got some in New York, New Jersey. He's got some in London, I think. And I think he has some elsewhere. So gold is, and gold, as I said, has the negative attribute of being, the supply does grow in small increments every year. Having said that, we actually own a gold miner. We believe we own what we believe is the best gold miner. It's in your portfolio, Larry. And we have a mining research analyst who used to work with me at Donaldson, Lufkin, and Jeanneret, and he's our consultant. He's absolutely fantastic, and he has walked me and Jack through. Jack Shibley being my investment colleague.
I'd like to talk to you about a really powerful financial planning tool to help you make smart retirement and other critical financial decisions. It's a tool that factors in all your financial data and shows you what you can sustainably spend every year for the rest of your life. That tool is my software company's Maxify Planner. It's incredibly powerful, it's accurate, and it's easy to use. Maxify takes the guesswork out of financial decisions at every stage of life. Its focus is on raising, de-risking, and sustaining your living standard. Maxify lets you run what-if scenarios to see how your finances will change in taking new jobs, buying a home, doing Roth conversions, retiring early, downsizing, investing more in the market, you name it. Knowing the impact of these decisions before you make them is the secret to making smarter decisions. And it's also the secret to what we all seek, which is financial peace of mind. So please visit Maxify.com today to start planning. That's Maxify with an I, Maxify.com, Maxify.com. Now let's get back to the podcast.
Partner, we've walked through the all the gold miners and concluded this had the lowest risk of having mines taken back from them by foreign governments. Always a risk. Most of their mining is in Canada and Australia. So we feel it, and that's been a very good play. It's a leverage way to play gold. We also have a gold royalty company investment. So we like gold as a hedge against inflation.
Cool. So what I'm gleaning from here, this discussion is that the market, or at least the Magnificent Seven tech stocks, might be, you think, have run their course, and that trying to hedge against that, perhaps by equally weighted, by moving your money out of the S&P into an equally weighted S&P, some fraction that might be a decent hedge for their collapse or decline. But that Bitcoin may actually not be crazily overvalued, as a lot of people might think, and even yours truly.
I think it's very age cohort driven. I think if you talk to people in their 20s and 30s, most of them. My son is 41. He's in the private equity business. He thinks Bitcoin is silly, but he and I have great respect for each other and a great relationship. But he thinks it's silly. But we don't agree. But I think generally,
I guess let me just say where I'm coming from on the Bitcoin.
Yeah.
my big concern, I can see that it's like a doomsday hedge, and actually Jonathan Troussard, who's a former student of mine, runs a Troussard Capital Management. He wrote a nice column about that. I'm going to post on my Substack
Hmm.
newsletter. Anybody can get a free
Yeah,
lifetime license to subscription to my Substack if they just go to LarryKotlikoff.substack.com, a little ad here, and
good, good.
and I'll convert whatever you do into a lifetime free subscription. But anyway, the concern I have is really with central banks issuing Bitcoin, not Bitcoin, but digital currency,
Right.
because now you have it's not exactly the same. Bitcoin is kind of independent of any central bank or any government. Uh, but on the other hand, you could, there's something a little bit more fundamental. If a central bank is issuing it, you can pay your taxes with it, right? And
Right.
you can also, uh, in effect, have a checking account with the Federal Reserve, rather than with the next Silicon Valley Bank that might go under, right? So that might take kind of there's something like 20,000 cryptocurrencies out there, right? And
And in our view, most of them are junk. Almost, in fact, our view is that the only cryptocurrency we can recommend to our clients, and by the way, we do not buy Bitcoin in the Helix strategy. We ask the client, are they interested in Bitcoin? And that's a separate discussion.
that's
So
a separate fund.
yeah, we don't impose Bitcoin on our, I mean, you don't own any Bitcoin. Let me put that. We haven't snuck it into the portfolio. And
Yeah,
despite the existence of ETFs, which own Bitcoin, which by the way is a different way of owning Bitcoin, you participate in the upside. The negative is that it's not pure Bitcoin, but it's not a terrible way to play it. Uh, so there are different ways to do it. We think owning it physically has got some advantages, um, but in any event, so
there are, like with
but
everything, there
most of
are.
the cryptocurrencies, a friend of mine called me up on Sunday night and he said, or no, Friday, and he said, you got to look at XRP. This is the hot one, blah, blah, blah. And it's increased five times. But I look at it and I go, well, there's a billion coins that have been issued so far, maybe more. And maybe it's 100 billion. I don't know, some crazy number. And I look at it and I go, why would I own this? I mean, more can be issued. Again, see, a lot of these are they're promoters, okay? And basically they can issue as many coins as there's a market for it. So they manage the issuance. And in our view, it doesn't hold value. The secret sauce of Bitcoin for us is the limited supply. And oh, by the way, it's worth noting, you mentioned central banks earlier. As you know, central banks have been net buyers of gold quite strongly over the last 4 or 5 years. They have not, interestingly enough, that I should say that interest has not extended to the retail, to the individual investor. Remarkably, gold has not been driven higher by individual investors. It's been driven higher by central buying by
Central banks.
yeah, a lot of the central governments, a lot of them, not our friends, our allies per se, who are pulling away from using the U.S. dollar as their reserve as their reserve currency.
Uh-huh. Uh, yeah. So, well, we spent about an hour almost. Fred, do you have any general advice that you would want to
Yeah, I
portend?
mean, I
Advice you,
think
yeah.
I think it's one of my closest friends ran one of the largest private equity. I don't need to use his name here. He's a brilliant guy. I don't mind saying Tony James is a really brilliant guy. He was a president of Blackstone for, I don't know, 15 years, 20 years. Really smart. And he made the comment about 4 or 5 years ago that he thought the decade of the 2000s would be um, a very poor one for equity returns. And I think that's turned out to be wrong. I would have agreed with him and did agree with him at the time. and instead we have the S&P up 15%. Now we don't have the equal weighted S&P up 15%. That's more like 7 or 8%. So my point here is that it's very hard to predict how markets behave. I think we are of the view that stimulus will continue, inflation will continue, and that will drive that will allow stock market values to continue to be high, confoundingly, by the way, because in a higher interest rate environment, you would expect that valuations would come down. But you can be getting 6% on a corporate bond, and if inflation's running at 3%, that's not such a great real return in point of actual fact. So I think our view is that staying invested makes sense, but I think being diversified within a portfolio is important. I think there's a lot of momentum right now. We have tremendous animal spirits present. Investors are very excited about the returns they've seen. We're very excited and very, very concerned, quite honestly, because when we've had a couple of years of really great returns, and we've kind of run against the grain in terms of the conventional thinking. We weren't heavily the Magnificent Seven. As you know, I think we have one holding at present, which it falls into that category, that being Amazon, as you know, Larry. But I think I think being active and trying to find real value. We're finding real value in some of the smaller cap, mid cap stocks, which, interesting enough, because we manage relatively a small amount of money, if we managed 5 billion, it wouldn't be available to us in the one strategy, at least. But managing 100 million plus in this strategy, it enables us to buy a company with a market cap of 4 or 5 or 600 million. We have to be careful. Sometimes it's hard to get a big position in that because of trading constraints. But I think staying invested in equities makes sense. I think being cautious about fixed income is important. I personally don't think that. I know everybody talks about the Fed, but the Fed is short-term rates. That's really the cost of money for small companies primarily, and short-term debt in particular. But if you look at the housing market and you look at where mortgages are today, and you look at cost of labor and inflation there, all of that says to me that long-term rates are not going to be substantially lower. I think a 10-year, if a 10-year is at 4.5% to 5%, what does that mean for mortgage rates? Well, there we have it. Mortgage rates now are 6.5%, 6%. And for most people, the housing market has to break. That's all there is to it. Has to break.
So maybe stay away from REITs or stay away from.
We don't invest in REITs because we generally have a point of view on interest rates that is, we think they'll be volatile. I would stay away from REITs, but that's just, we would stay away from REITs because we haven't researched them well enough. Okay. We would have to do a really deep dive into REITs for a month and kind of figure out.
Real estate investment trust, for anybody who doesn't know what REITs mean. Real estate investment trust, or real estate equity investment trust.
No, well, some are income and some are equity, but the truth is that real estate, it's a way to play real estate, and some are focusing on commercial buildings, some are focused on retail, some focus on malls or strip malls, some focus on warehouses. There's various REITs. Some are diversified across all those categories. Let's remember, however, that real estate is generally, particularly on the commercial side, is a pretty good hedge against inflation. So, it's possible we should be owning real estate, but we don't.
Fred, thanks a million. This has been great. We're going to get you back, of course, and thanks again.
Thank you, Larry.